Good evening, everyone. It's a Sunday here in Guam. I know it's a bit late on posting for week number 6, but I wanted to make sure that we have a good idea on where we're at because we're going to be building in the concepts, right? So I needed to create an additional Excel file so we can work on it and see the examples rather than using the PowerPoint. So I do hope by now that you're looking at your books also, you're reading through it, there's exercises there, and then so you can actually go to the train of thought, right? So for this week, we'll working on the valuation and then rates of return. So it's a concept of what is valuation, how do we compute it, and then it's for both debt financing through bonds and then equity financing through stocks, right? So last week, we finished present value calculation, a bit of math, but this time around, what we're going to be doing is that we're going to be using most of the concepts on the present value for this calculation on valuation. So on the valuation, question that would arise is that if I am looking at stocks and I know that these are the dividends that the stocks are giving annually, how much should I buy that stock for? So that's the premise of this week's discussion. At the same time, if I am investing on bonds and then I know the bonds are giving me a coupon rate or an interest rate of this much for this number of years, how much should I, as an investor, pay for that bonds or expected to pay for the bonds? So that's the valuation part. And then the interest part is actually on how do we actually use the interest rates on that calculation. So let me go through a quick one here so we know where we're at. Oh, let me just use a different color. So last week, week number 5, or we're looking at chapter 9, we look at the present value concepts. So this week, week number 6, we're now looking at chapter 10 of the book, and then we're going to be looking at what are the valuation or what are the rates that investors are looking at, and also what's the valuation. Because as we go through chapter 11, we would say, let's now invest on the business by making it, the business needs to grow. And in order for us to grow the business, we need funds. And then, as we were discussing since day 1 or week number 1, the way to invest on companies is that either using your own internal funds or getting funds externally, external financing, either through debt or equity financing. So we're going to go there on chapter 11. Now, on chapter 12, we're going to be looking at it on a project-based analysis. So this is actually where we do like the net present value, the interest rate, rate of return, internal rate of return, and then the payback period. So we're going to be looking at that one. But that will be on chapter 12 a couple of weeks from now. What we're trying to do is build the concepts as we go through the chapter. So, and then there will be one time that we're going to tie everything up. So you would actually remember it as you go to your other classes, or if this will be your final class before you graduate, you'll be able to apply it. Okay. So valuation is based on a lot of the question of what is the future cash flow that you're going to be receiving from an investment, and what is the rate of return that you are thinking. It's all about if I make an investment right now, that's the present value, and then I know it would actually grow future value based on an interest rate, like the R or the I, right, on our formula for present value and future value. And then the amount will actually be the calculation. So that's the valuation of this either the stock or the bonds. Now we're gonna go first on the valuation for bonds. So let me just make sure that we have a background of what are bonds, right? So bonds are debt instruments. So you invest on bonds, and then either the best example for bonds would be T bills or treasury bills issued by the United States government, either on a 5 year or 20 year or 10 year, depending on. Now, the longer that you are investing on the bonds, the higher the interest rates are. Why? Because you would think that if you put money on the bonds and then they would tie it up for 10 years before they return it to you, then you would want to have a locked in interest that's actually higher. If it's short as an investment, then the interest will be lower. So that would make logical sense. At the same time, on a bond transaction, you as an investor would actually know that there is a coupon rate. So a coupon rate is similar to an interest rate. And then basically, so coupon rate is equal to the interest rate. Now, for example, they would say that, hey, you know what? Every year, as you invest on a bond, you would actually earn 10% every year. Now, 10% can be every year or can be paid semi-annually. So it will be like say 5% at 6 months and then another 5% under 6 months. So it can be that way. Now, there is a par value or a face value for bonds, and then that can be say $1,000. $1,000 means that hey, the par value of the bond is 1,000. And then the term can be, say, for a period of time, 10 years. So buy now bonds, have it at 1,000, and then it will be invested for 10 years. And every year, for 10 years, you will get 10% of the 1,000 or $100. Every year, you're going to get that as a interest. So not too bad when you look at bonds, right? So it's a consistent payment of how do we get the interest amount? Interest amount that we will receive is basically 1,000 on the face value multiplied by 10%, which is actually $100 each year. Now, bonds can actually be sold on a discount, meaning that you will buy it less than 1,000, which is the face value, or you can buy it on a premium, which means that you might buy it for 1,200 or 1,300, higher than the par value or the face value. So we're going to be looking at today valuation for bonds. Now, I have some items on the PowerPoint, but I would say that it will be best doing it on Excel so you can take a look at it. This one seems complicated, but it's not. And then it looks like it's actually familiar because it is, right? So remember the present value calculation? What we're trying to do now here is that PB is the price of the bond, and then it's actually equals to both interest and then principal. I is actually the interest based on the number of payments or what's you're going to be receiving as interest. And then at the end of 10 years, right, where we're saying at the end of the 10 years, yeah, and you will actually get your principal amount, which is the face value. And then, of course, you're dividing it with 1 plus y to the nth power. And then t will be the number of period of time. And then y will be the yield to maturity. So some books will actually call it yield to maturity is actually similar to interest or the effective interest rate of the bond itself, right? So the best way to explain is through an example. For example, the one on the bottom, right? Assuming there is a interest payments of $100, so 100, for the principal payment at maturity, so 1,000, and then the due to maturity at 10%. And then the question is for 20 years, what is the value of the bond? So it would mean that you will pay, or after investing it for 20 years, you'll get $1,000 at the end of the 20 years. And then also you're going to get $100 each, the interest, which is actually basically 1,000 times 10%, this is 100 for 20 years. What's the amount that you need to pay for the bonds? Let me just go to the next one. And then that would mean that you would need to have the face value of the bond will be 851 and 36 cents in order when you actually do a 10% yield to maturity at 20 years and then getting an annual interest of 100. So that's the calculation, right? Now, we do have here some calculation. I'm going to go through the PowerPoint quickly, but we have this explained on Excel. I just want to make sure that when you go through the PowerPoint, you can see where did I stop, right? We would actually be going through the interest rates, which I'm going to go back here. But so far, let me just explain the interest rates because this one's actually important. We talked about yield to maturity. So YTM, yield to maturity. So yield to maturity is actually the required rate of return, which is the 10%. We saw that a while ago on our first example. Now, the yield to maturity or the required rate of return consists of certain items, right? So what are those items? Now, one of the items is actually what is the real rate of return for that bond transaction? It's really 3%. But of course, that 3% a real rate of return, so the operative word is actually real, it does not include any inflation. So remember, it's going to be for 20 years, right? So you do not want to tie up your money for 20 years and then not account for inflation. That will be unfair to you as a investor. You're going to tie up the money for 20 years and then nobody would actually give you an offset to inflation. That's why there will be an inflation premium that will be added. So now you have 7%. So this will be your risk-free rate. So risk-free rate is basically the rate that it will be given to you as a investor, knowing that the investment to the bonds are actually guaranteed by the US government. So it's called a risk-free rate. It consists of both the real rate and then also the inflation premium or inflation adjustment. So for now, we'll just talk about it as a concept, right? And then later on, when we go to chapter 11, between 11 and 12 on the book, we would actually go through the calculation of the weighted average cost of capital. So we will explain it more. At the same time, you as an investor, you always look for a risk premium. Hey, I know that the US government has a risk-free rate for treasury bonds at 7%. But as an investor, you always expect something more to it because you're gonna tie up your money. So that will be the risk premium, depending on the country that you are at, depending on the current state of the economy, then that will be your expected return as an investor, or the term that we use is actually the required rate of return required by the investor, or in our calculation a while ago, is the yield to maturity. So I wanted to focus on the words that are being used to describe each one. Required rate of return is similar to rate of yield to maturity. And also what are the composition? Because later on we're going to be calculating it. But I know there's a lot that's being built in right now, right? But don't worry about it because later on when we go through the weighted average cost of capital, it will be more clear. So for now, let's understand that the required rate of return or yield to maturity consists of the real rate of return that's not adjusted for inflation. That's why you need to add inflation premium, which will be your risk-free rate, plus you add the risk premium, so that will be your required rate of return. Now, the required rate of return right now is actually 10%. So it can be 12%, it can be 8%. So we're going to be looking at three scenarios wherein the required rate of return is either higher or lower than the coupon rate. So I need to make sure that we actually have so the required rate of return, we have a comparison, right? Let me make sure it's a bit big. Okay, there you go. So the required rate of return is basically similar to the yield, right? Yield to maturity, or which is the YPM. Now, YTM or the required or the yield to maturity is actually different from yield to maturity is actually different from the coupon rate. So the coupon rate is actually what is stated in the bond document. So the bond would actually have a document. It's a the bond is basically a piece of paper, a bond debenture, right? But in most cases right now, it's actually electronic form. But the bond would state all the requirements of what is the bond, what's the face value, who's the one issuing the bond, when is it going to be maturing, and then all the other legal aspects of it. But the bond would state a rate saying that I would pay as an issuer of the bond to you, the bondholder, an interest rate, which is the coupon rate. So the interest rate is basically the coupon. Okay. So what is stated is 10% of 1,000, which is the face value of the bond. So it's $100. It's just so happened right now it's actually the same. The yield to maturity is 10%, the one that you're expecting or the one that you're requiring as a rate of return, which is the same as the interest rate of the bond or the coupon rate of the bond. But in certain cases, the coupon rate of the bond is 10%, but you want a higher yield to maturity. Or sometimes you are okay to have a lower yield to maturity. So what will happen on that case, right? That's where the valuation happens. Now, with that in mind, I'll go to the impact. So here it became 12%, and then we have a number. Don't worry, I'll explain to you on the Excel file. And then also later on, they actually have a number which is actually at 8% now. There's a decrease in the inflation premium, right? So rather than having it at, I think we had it at 4%, if I'm not mistaken. 4% earlier, and it became smaller, so at 2%. That's why the required rate of return on our third scenario went down to 8%. So with that, I'm just going to show it to you that it actually we had three scenarios, 8%. And then we're going to be calculating now. So instead of me doing this long in a PowerPoint, I would rather give you an Excel file to actually calculate it. So I'll switch on the Excel file, okay? Escape here, move it around. And I could not move it around. Kindly hope guys can. I have two screens just in case that you're wondering what I'm doing on the other side. So I have a screen here and then I have the screen here. So this file will be sent out and posted in our Canvas, and then you have two sections. The bonds. Let me make sure we have a different color for each one so you can actually see it. The bonds and then the stocks. Okay, there you go. So we're gonna go first on the bond side. Now let's make it a bit big, and then here on the bonds. This is where we're saying that the yield to maturity is 10% as given, or the required rate of return. And then the coupon rate, what's the coupon rate again? It's the interest rate that is actually shown on the face of the bond, right? So why is it called coupon? So coupon rate because before, let's say back in the olden days, if I have a if I have a bond document, for example, this is my bond document, right? If I have a bond document, I would actually have another attachment, another paper, which is actually attached to the document. It's a coupon, and then that coupon shows you the interest that you would actually receive after 1 year, and then you actually exchange it with the bank. So that's the reason why they call the coupon rate. So like an attachment to the bond document. And then that is only for you picking up the interest that you're going to receive. Now, in our case, in the digital world or the now, everything is digital. It goes to your bank account, your electronic bank account automatically, but we still call it a coupon rate or the interest rate. Okay, so the face of the bond is 1,000. So remember, it's going to be all the same, right? And then the only difference is that the expected rate is 10%. Then we're going to go 12% and we're going to go 8%. But the premise of the bond is actually the same. And then we're going to do the valuation. It's the valuation part that's important to calculate. Let me clear it up again. Face of the bond is 1,000. The coupon or the interest would actually be 100. So where did we get 100 again? It's 1,000, the face multiplied by 10%. So if you multiply that, it's going to be 100. So that's why the interest rate is actually 10% right now. And then here, the period is actually is 20%. Okay. I should change this one as interest rate to yield or rate of return. The expected rate of return. Let me just make a change on that one so it's actually clear to us. So we know it's not a coupon rate, but this will be the base case that we have. Now, remember the formula that we have on equals PV, right? Let me just clean this up. On the equals PV, what happened is that I would actually have the present value, which is actually here. Present value is the interest rate multiplied by the number of period, 20 years, and then how much is the payment and the fair value. Now, we're going to be computing by including the payment, which is $100 each year, and then the fair value, or not the fair value, accountant always uses fair value, future value, which is the face value of the bond, because that's the amount that will be given back to us after 20 years. And then computing of how much do I need to pay for this bond. So it's basically the price of the bond as of the now, which is actually what we're trying to compute. What is the amount or the value of the bond given that it would earn a coupon of 100? I'm expecting a 10% yield to maturity, and it's for 20 years at the face of 100. So that's the valuation. Let's do it this way. If I do this, it will be C9 will be C9 will be the 10% here. And then C10 is the number of years, which is 20. And then here is actually the payment of C8 of $100. So that's why what we're trying to do here is only calculating the present value of the interest payment. It's the interest itself. But here, it's a bit different, okay? Let me make sure if I do this, it's going to go up. Let me do it this way, guys, okay? There you go. So at least you can see the color coding rather than me circling the cells, right? C9, which is actually the 10%, which with the NPER, the number of periods C10, 20 years, then the payment PMT is actually C8, which is where is C8? C8 is actually this one, the $100. But at the same time, we would know that the future value, it's going to be C7, which is 1,000. So that's why we know, given that these are the provisions of the bond, we will be paying for the price of the bond right now, or the value of the bond. I would just say the value or price of the bond right now is actually $1,000, right? So why? It's just so happened that the yield to maturity, the required rate of return of 10%, is equal to the coupon rate of 10%. And then that's why the value is also 1,000. And how do we break down the 1,000? Why did we compute this interest payment? Because the 1,000, when you add both, let me just make sure you can see it. When I add both, the interest and then the principal is basically $1,000, the price or the face of the bond. And how did I get that one? Because we actually compute for the present value of the interest payments that will happen for 20 years, right? And then, of course, the difference is actually the principal. I just deduct. And it's based on what? Based on a inflation rate of 4%, real rate of 3%. That's why when I add both, it's actually at risk-free rate. Then I add the risk premium, which is actually the 10%. So what does it all mean, though? What does it all mean when we come to the yield to maturity or the required rate of return is equal to the coupon rate? So since the bond is paying 10%, and the investors are also demanding 10%, which is the required rate of return, the bond is perfectly priced at its face value of 1,000. And how do we know it's perfectly priced at the same amount? By doing the present value formula calculation. So now that we know that, what's the implication? Investors do not need to pay more or less for the bond to adjust the return. The bond is priced at par value. So meaning the market price is the same as the fair value. Now, let me make sure I'll take out the free fingers, okay? So at least it's not too distracting. But I need to make sure I have the yield to maturity here. Nope, not that. Let me just make sure to include it. I'm sorry. Okay, I can do this. There you go. Well, it would still work. Now, so what am I trying to do right now? What I'm trying to do right now is actually, I'm gonna go here. I'm gonna calculate. I'm gonna make it a bit small. I'm gonna mix our Excel files so you can actually see it. One more small. And then I'll make it a bit big because later on we would actually need to see everything else, right? Okay. We would actually take a look on a calculation on the cash flow. So it's the movement of cash. And I have here year 1 all the way to year 20. So what happens? On year 1, we would need to pay the par value of 1,000 to pay for the bonds. Each year, from year 1 to year number 20, we will get $100, right? $100, which is the interest. At the same time, on year number 20, not only will I get the $100 for the interest, I would also get this 1,000 here. The payment that I made as a return on year 1, because basically I'm liquidating, or the investor will get now the return of the principal and the interest, right, for the bond that I paid. So simple enough. I have here as a negative because it's a cash outflow, and then everything is positive because it's a cash inflow. I will add one more formula. One formula that I added is actually I equals IRR. Means that it's the internal rate of return. It's easy to do as a formula. Equals IRR. Internal rate of return, open, and then it would actually be the beginning to ending. Actually, the formula here is a guess, right? It's a guess. It would need to calculate all positive cash outflow and cash inflow. And then when you click that one, it's going to show you the yield to maturity. So the yield to maturity is also what you call for Excel formula is the IRR, the interest rate of return. Just make sure we copy that as we build our calculation. Of course, I have a wrong spelling. There we go. So now we know that it's really 10%. We're just trying to prove it's 10%. At the same time, we're trying to prove also that our calculation of the interest, the present value of the interest, is correct, which is actually this one. I can do that by doing the calculation of the present value. How much is the interest? $100. And then 1 over 1 plus I to the nth power. What's the nth power? Is actually each year it's an n. And then that's why I put the numbers there. And then from there, I can actually get the present value. So here, the red one is A41, A41, which pertains to the year, right? So as I go through, the years actually changes. So the $100 of interest multiplied by the present value factor to discount it, and then basically what we're trying to say is that, so what does it mean? It's a long calculation. On the 20th year, how much is the interest I'm going to get? It's $100. Everything is $100. But as of today, so it will be 20 years from now that I'm going to get $100. But the value of that $100 20 years from now, as of today, is only $14 because I discounted it to the now. And then if I add everything here, the $100 a year from now, the $100 2 years from now, and the $100 20 years from now is $14. If I add everything up, it's $851.36, which pertains to the same thing now, which is the same calculation. Okay, so I know we're doing calculation based on the math itself, and then hopefully by now you're seeing the logic on how we're building it up, right? So that's why it does not give justice when you take a look on the PowerPoint, because the PowerPoint has pictures of the calculation. So I need to show you how it's being done on Excel format and then using the Excel functionalities. Now, we're going to go through 3 different scenarios. So that's the first scenario. Scenario number 1, we're in the yield to maturity or the IRR or the required rate of return, same thing, right? It's the same as the coupon rate. Now, what if it's actually different? What if the investors are expecting a 12% return from a 10% coupon? So how much now would be the value of the bond? So long story short, if I pay for a 10% coupon rate, expecting 12% of a yield to maturity, the price that I should be paying is only $850, discounted. When you think about it, discounted. Why? So why is it discounted? The same calculation goes, right? I'm going to do a quick one. It's the same formula as what we have done on the first situation or the first scenario. It's the same formula on the value of the price of the bond compared to scenario 1. And then the principal or the present value of the principal is basically deducting the value or the price of the bond minus the present value of the interest payments. So the reason why it became 12% is because why? We changed now the inflation rate. So that's a scenario discussion that we have. It was initially at 4%. What if we are looking at an interest rate in the future of 2% higher? That's why the rate of return is now 12%. On the third scenario, what if we're looking at an inflation adjustment that's actually lower than originally at 4%. So it's a lower rate of return. Okay. So why does the price go down? What do I mean? Why does the price go down? We need to answer the question, why does the price go down compared from 1,000? It's now 850, but I have a return that's a rate of return higher. But why does the price go down? So let's take a look at it. Since the bond is paying only 100 a year, which as stated, the coupon rate, and the investors want 12%, stated also, which would be 120 a year. That's the expectation, but you're only getting 100. Nobody is willing to pay a full 1,000. Why? Hey, I'm hoping it's 12%. Well, I'm going to give you 10%. I'm hoping it's 120 per year, the yield. No, it's only 100, which is the coupon rate. So nobody wants to pay a full amount. So meaning the investor wants a better deal because they are not getting the return they expect from the bond's fixed payment of 100. You're expecting 120. To fix this, the price of the bond drops down to 850 and 61 cents. The valuation aspect of this chapter is actually the calculation of the present value, which is still the factor of equals PV, the interest rate, comma, the NPER, comma, the payment, which is the monthly payment or the annual payment of 100, then the FV or the future value, right? By this time around, you're gonna be remembering the formula as you do it in Excel because this will be our second time doing it. Or after second week doing it, and then we had your assignment also last week. So the important one, that's why I wanted to make sure we include this one, is that it's important to see it side by side. Why does the price go down now at 850? It's because you are asking for 12% or 120 each month, each year, but you're only getting 100, so you don't want to pay for a full price of 1,000 or the face value. Say, discount me that one because it's not meeting my expectation, but let me just, here's the money that I would want for that investment. And then the calculation goes for everything else in between. So same here for the present value of the cash flow. So the interest rate here is 746 and 94 cents, which is the same as what you have here. So you can see it's actually the same, right? Maybe I should actually do a same, maybe not that. Same color for that here. And then just to highlight it. Okay. Yeah. And so it's the same as we see it, and it's all the same for scenario 1 and then scenario 2. Now, I'm going to go through one more time. What's the logic behind this Excel file or Excel calculation? You have $100, still the coupon that you're receiving, and then you're doing it with an interest rate now at 12%. So this one is at 12%. A while ago, this one is actually at 10%. So I'm using that, which is actually F40. That one is F40. And then E41 is letter E. 41, I'm just using the years because that's the discount factor. And then it's not an absolute reference in Excel. You don't have the dollar sign in between letter E, the beginning and after letter E, unlike this one. So there's no absolute reference, so it actually goes down. Okay. What do I mean by that? If you go to Excel, it just goes down. The exponent or the representation of the number of creative. And then what does it mean again, though? What it means is that the $100 that you would receive at the end of year 1, in the now, if you're going to be paying for that bond, is only $89.29. After year 2, that $100 to the now is actually $79.72. The $100 coupon payment that you're expecting 20 years from now is actually valued at $10.37 as discounted by 12%, which is the rate of return. So this will be the present value of the investment. Now let's go back to the cash flow, right? The yield. So what's the yield that we're looking at? We're looking at a yield of 12%. Is it really 12%? Yeah, says so. Why? Because we have the internal rate of return calculation. But now the difference is that we're using 850. So you paid less compared to here as an offset of getting only 100, which you were thinking is 120. That's why you would say it's 12%. Because you might say, okay, wait a minute, why is it 12%? The yield is actually higher, although I'm getting only the same $100 each year. Well, the reason why is that you are getting 100 for each one, but what you're paying on the start is actually different. You're paying less compared to before at 1,000. And then the differential, like $150, right, translate to a 2% increase in the expectation that you have, which is the yield to maturity. Okay, so hopefully it's actually sinking on that one, right? Now, it goes without saying that scenario number 3 we're in, you have the interest rate at 2% now on the inflation from 4, right? It became 6, now it's 2. So your required rate of return is 8%, the rate of return. And then now the present value of the interest payment is actually 981. And then now you wanted to pay higher. Okay, a bit odd, right? Why would you pay higher for a rate of return that's actually lower? So let's take a look on the reasoning. Why does the price go up? It's reversed on why does the price go down? Since the bond is paying 100 a year still, coupon rate, and the investors are only asking for 8%, hey, about $80 of me, which will be 80 a year, the bond is now more attractive to the investor. So they are willing to pay more than 1,000, which is 1,100 plus, because they're getting a better deal. So it's now paying 1,196. So you can see that the application of the formula is that you would not be able to calculate the present value or the valuation of the bond depending on the rate that you're expecting compared to the coupon rate that's actually stated on the bond itself. So why investors are still getting 100, even more than 1,000, even in this case 1,196, even though they're expecting only 8%. Okay, and then here, so it's going to be the same calculation, and then here's 8%, same logic behind it. I'm getting 100 based on the 10% of the face value. Well, why am I getting only 8? Because you paid high in advance. That's why it's going to be 8% as the rate of return. Stated another way, you only want 8%, but you're getting 10% rate of return or 10% coupon rate. That's why you would want to pay for a premium, or you would want to pay a higher amount for the face value of the bond. So logic-wise, I think everybody's okay. What we wanted to make sure we understand is actually the formula. And then the formula now is computing. We filled up all four requirements. Make sure I have this one. What do I mean that we filled up all four requirements? I'm gonna do this, and it's gonna go to my screen on the side. I have a screen capture, and then I'm gonna do that and paste it here. It is now completing the rate, the NPER, the number of periods, what's the rate? And 8%, 20. What's the payment? The payment's actually 100, the coupon, like for 20 years. And then the future value is the face value. Why is it future? Because you're going to receive that at the end of 20 years. But for now, your present value, which what you're trying to compute, is 1,196 and 36 cents, which is actually the difference between when you compute it. You can compute this one, right? When you compute this one, you're just your present value for the interest payment, you're just basically taking out the fair value, and then the differential is actually the principal amount. And then that's why the math would always work. Okay. And then what is the bond? I just put here what's the bond, and then what's the yield to maturity as an example. But with that, it's an easy, I would say it's an easy, right? It's an easy calculation of valuation for bonds. We're gonna go to the next one, which is actually stock. A bit more interesting, because we would actually have an additional concept, and then also we would have a bonds discussion, or your quiz will be also on the stock side. So make sure to actually go to the second video, which is actually all about stock valuation. So I'll see you on the next video for this week. Thank you.